Welcome back to another Explainer. Today, we're grabbing our scalpels and doing a deep dive autopsy on a seriously fascinating earnings report from an absolute titan of the industrial world, Dow Inc. Their second quarter 2026 numbers are out, and guys, it is a wildly interesting story. It's basically a masterclass in how a company can completely turn its profitability around, literally making way more money, even when the actual volume of what they're selling takes a bit of a dip. So, let's get into it.
Okay, before we get completely lost in the spreadsheets, let's just ground ourselves on who we're talking about here. Dow is a true material science giant. Honestly, if you interact with flexible food packaging, automotive parts, infrastructure, or even just basic home care products, you are almost certainly interacting with materials engineered by Dow. They operate on this massive global scale, and because their materials are literally the building blocks for so many everyday goods, their financial health is usually a pretty solid bellwether for the broader economy. All right, here is our roadmap for today. First, we'll hit the billion-dollar headlines. Second, we'll look at the prices up, volumes down dynamic. Third, we'll unpack their transform to outperform strategy. Fourth, we'll do a segment-by-segment breakdown. And finally, number 5, the outlook for the future. So kicking things off with section 1, the billion-dollar headlines. Let's look at the top-level numbers that really grabbed Wall Street's attention this quarter. Dow reported net sales of $12.1 billion. Now, in isolation, sure, that's just a huge number. But context is everything here, right? That represents a massive 20% increase year over year. That is a truly huge jump in top-line revenue for a company of this immense size, and it actually reflects increases across all of their operating segments and global regions. Moving down the income statement, we see a GAAP net income of $802 million. So obviously they brought in a lot more cash, and they kept a really healthy chunk of it. But, to really understand the operational turnaround here, we have to look at this next metric. And here is the punchline. Their operating EBIT, that's earnings before interest and taxes, hit $1.6 billion. Let me just put that into perspective for a second. That is an unbelievable $1.7 billion jump from the exact same period last year. Just think about that swing for a moment. It shifted their operating earnings per share from a 42-cent loss in the year-ago period to a $1.44 gain today. I mean, that is just a phenomenal turnaround. Which brings us to section 2, prices up, volumes down. Now, what's really interesting about this is how exactly did they pull off a massive 20% revenue jump and a multi-billion-dollar profit swing? Like, did everyone suddenly just start buying way more Dow products? Well, no. Just think about the divergence we're seeing. On one hand, local prices increased by a whopping 20% compared to a year ago. But on the other hand, physical sales volume actually decreased by 1%. This means Dow leaned incredibly heavily on their pricing power. They were able to charge significantly more for their materials, and that more than offset the fact that the actual physical amount of stuff they shipped out the door shrank slightly. So you might be wondering, why did volume drop by 1%? Well, the earnings report directly attributes this to 2 main factors. First up, planned maintenance activity, which is essentially just taking certain facilities offline for routine upkeep, particularly in their hydrocarbons and energy business. And second, geopolitical headwinds. The report explicitly notes that the ongoing conflict in the Middle East impacted demand and logistics, especially in the regions they categorize as MEI, that's Europe, Middle East, Africa, and India, as well as the Asia-Pacific region. All right, moving on to section 3, transform to outperform. Now, raising prices wasn't the only way Dow boosted their bottom line. If you read the report, you're going to see this phrase everywhere, transform to outperform. So let's strip away the corporate jargon for a second. What this really means is a massive, aggressive cost-saving and efficiency drive. Dow actually refers to this as their self-help initiative. It's all about restructuring, cutting unnecessary costs, optimizing their footprint, and just making the entire organization fundamentally leaner so that literally every dollar of revenue yields a bit more profit. And honestly, it seems to be working even better than they initially projected. Just listen to this quote from Dow's CEO, Karen C. Carter. She said, "Market conditions were supportive this quarter, and our self-help initiatives delivered ahead of plan. We now expect to generate approximately $200 million more in benefits from Transform to Outperform this year, enabling us to increase the total in-year benefits from self-help to greater than $1.3 billion. That is a massive amount of internally generated cost savings hitting the bottom line. Let's dive into section 4, segment-by-segment breakdown. So, we've seen the big picture.
Now it's time to put the specific divisions of Dow under the microscope to see exactly where these gains actually happened. The crucial point is obvious when we look at the breakdown of Dow's three main operating segments. Just look at the scale difference. Packaging and specialty plastics is the undeniable heavyweight champion of the company right now. It pulled in $6.4 billion in net sales and generated a staggering $1.3 billion in operating EBIT. Industrial intermediates and infrastructure, and performance materials and coatings, while they are significant multi-billion-dollar businesses in their own right, they just do not have the same immense profit engine as the packaging division this quarter.
And if we zoom in on that powerhouse packaging and specialty plastics segment, we see it perfectly mirrors the overarching narrative of the entire company. Local prices in this specific segment absolutely skyrocketed by 30%, which was largely driven by higher polyethylene prices globally. Meanwhile, volume for this segment dropped by 4%, again mostly due to that planned maintenance and those regional conflict impacts we talked about earlier. So high prices heavily offsetting lower volumes, this segment is really the macro story of Dow's quarter in a microcosm.
But hey, there is always an exception to the rule, right? Over in the performance materials and coating segment, we actually saw a 6% volume increase. This was the one major area where customers were physically buying more product year over year. Dow attributes this volume growth to downstream silicones, specifically demand coming from consumer applications, electronics, and home care products. So that's a really interesting bright spot for physical demand.
Finally, let's wrap things up with Section 5, Outlook for the Future.
As we all know, the stock market is a forward-looking mechanism. Moving into the second half of 2026 and into 2027, CEO Karen S. Carter laid out three distinct strategic priorities. Number 1, pursuing growth and innovation in attractive end markets. Number 2, investing in and strengthening their world-scale, low-cost global positions. And number 3, ensuring balanced capital allocation to maintain financial flexibility. Carter also noted that the cost-saving impacts of their Transform to Outperform restructuring are going to ramp up significantly through the rest of this year and into 2027, setting what she calls a new competitive standard for the company.
Which leaves us with this final, somewhat provocative thought to take away from today's explainer. Dow just had a spectacularly profitable quarter by flexing its pricing power and aggressively cutting costs, all while shipping slightly less physical product overall. But looking ahead, if global demand and physical volumes remain stagnant, or if they face even further geopolitical headwinds, can Dow's pricing power and internal self-help initiatives actually continue to outlast potential macroeconomic shifts? It is the ultimate test of their long-term resilience, and for sure, it's exactly what we're going to be watching for in the quarters to come. Thanks so much for joining me on this deep dive. Keep asking the right questions, and I'll catch you in the next explainer.